Michael Howell, CEO of CrossBorder Capital and author of the book Capital Wars, The Rise of Global Liquidity. It is so great to welcome you on the show. Thank you so much for joining me, Michael.
Great pleasure, Julia. Great to be here.
Well, I'm really excited to have this conversation with you. I think it's such an interesting time in our world. And, you know, one of the places I always like to start with my guest is just getting their big picture, the macro view. What is that for you today? And then we can start to zoom in on some of these ideas.
Okay, I think the sort of big picture, the $64,000 question, if you like, is what's driving markets. What always drives markets is money flows. If you want to know what markets are going to do, watch the money, follow the money. And that's pretty much what we do. I mean, that was a legacy that I inherited, goes back to the days I worked at Salomon Brothers, the US investment bank back in the 80s and 90s. And Salomon was basically all about understanding money flows. That was the the remit, if you like, of the research department. That's what Henry Kaufman, who was head of research, basically had pioneered. And Salomon was all about understanding the flow of money and trading accordingly. As we know, there were big proprietary and very successful proprietary traders for many, many years.
Yeah, the money flows. Let's go. Take me back to that time. That was the mid 1980s. Salomon Brothers. You all were really pioneers of following the flows. What was it? Why was that so important to follow the flows?
Well, I think there was a number of reasons there. I mean, one was that the world was becoming international very quickly. I joined Salomon Brothers International in London. It was basically just beginning its major international footprint then. It had offices in London, offices in Tokyo. It went on to dominate, as many people would know, the Japanese financial markets. The US was so far ahead in terms of financial sophistication. The Japanese were always many steps behind in understanding what was going on in terms of futures, derivatives, whatever. Salomon Brothers really understood the dynamics of the JGB market, the Japanese government bond market. They basically, swapped techniques that have been learned in the US. A lot of the things that we are now very familiar with in financial markets were actually invented at Salomon Brothers, actually even before I was there. So things like understanding duration. Duration was a concept that Marty Leibowitz, who was head of bond research, basically had sort of plucked out of the history books, but reinvented in a way. The yield curve was ultimately a Salomon Brothers invention, how you trade the yield curve. And basically, you just go on and look at the history of finance, look at long-term capital, etc. It was all about understanding how to arbitrage fixed income markets.
Yeah, that would have been a really exciting time, I imagine, to be like coming up in the ranks, like witnessing some of this pioneering work.
Just read Michael Lewis's Liar's Poker. That
exactly.
will give you pretty good flavor of what went on.
Okay, so it's like similar to that experience, you'd say, like your time there?
Yeah, I think it was. I think there are parallels. I mean, there's a certain amount of fiction in that and sort of like poetic license, but I think he captured the flavor exactly. Yeah.
Yeah, I'm looking at my bookshelf. I have Liar's Poker sitting on the bookshelf of Michael Lewis. Okay, so flows is what really matters. What is it kind of signaling to you today? Can you kind of frame it up? Help us understand where we are today and what are you gleaning from paying attention to flows?
Okay, I think the first thing to do is to understand what we mean by the flow of liquidity. Liquidity, in our terms, the way that we define it, and actually if you go back to the book you referenced, Capital Wars, there's some very detailed definitions in there about how we define liquidity. But basically, it's the flow of cash and credit through global financial markets. Think of it that way. And what we're doing is we're tracking that. We track it at the moment across about 80 or 90 countries worldwide. So it's a very detailed and highly quantitative analysis. What we try and do is we try and reference that flow of liquidity and put it into a cycle so we can understand effectively where we are, where we come from, and ultimately where we're going to. And if you look at that cyclical development, that cyclical movement in liquidity basically drives financial asset markets and then ultimately the real economies. So you've got effectively a two-way linkage here, first into finance and then into real economic activity. Now, the point of talking about liquidity right now is that it would have been apparent to many of your viewers that financial markets have suddenly been kickstarted upwards during 2023. And the reason for that is the global liquidity cycle is inflecting upwards after having fallen very significantly in the previous 2 years. That fall was engineered by the central banks after the COVID emergency, where they'd thrown lots of liquidity into markets. They were in the process of taking that out very quickly because of the inflation threat, the spillover of inflation. But actually what you're seeing as of, in fact, the low point on our data was around October of 2022, you're beginning to see an inflection upwards. And markets are very, very sensitive to these inflection points. It's the financial markets operate, as you know, at the margin. So a little bit more money goes a long way. Now, many people might dispute that, and they might say, well, okay, this is simply a sort of a bear market rally. It's fake, whatever. Just take a look at crypto, okay? This is not an investment recommendation for crypto, and I would say there's probably not a lot behind crypto. That's obviously a debating point. But crypto is purely a liquidity phenomenon in our view. And if there is an absence of liquidity, crypto crashes. If there's more liquidity, crypto goes up. And what you've seen is a very significant rally in most crypto assets, but particularly Bitcoin. So that's one very important heads up. But then if you start to extend that and look at the character of what's been going on in the financial markets, you'll see that sector performance has been dominated by cyclicals, and particularly tech has had a big bounce. Now, in let's say in finance parlance, and sort of putting on my Salomon Brothers hat, technology is what is called a long duration investment. So most of the earnings out of tech is way into the future, which means it's very, very sensitive to very small perturbations in interest rates, bond yields, and liquidity. And so as liquidity is picked up, what you've seen is technology bouncing very significantly. So there's a lot of evidence that would tell you that there is an inflection going on in liquidity. Now, one important question, there's a corollary of that, is why is liquidity turning up? Particularly when the rhetoric of all the central banks, and particularly Jay Powell, is to say, look, we're still here for the long term. We're going to be holding rates high. We're going to nail inflation and don't expect a near-term change. Well, let me suggest there are two big changes in the world that we need to factor in. One of those is China. China, we know, has been in lockdown for many, many months because of COVID. It's emerging from that lockdown. And actually what the People's Bank of China, the Chinese central bank, has done is to basically plow a lot of liquidity into Chinese markets to help the economy revive, okay? Now, the scale of that liquidity injection needs to be understood. It needs to be understood not least because there are many pundits and analysts out there who claim that China is not easing. And I would say that they're not looking in the right area or not understanding the process properly. If you look at how the People's Bank operates in China, they have been injecting something like 3 trillion yuan, in other words, renminbi, into the money markets in the last 2 months. That's a circa 450 billion US. If you put that into context, that 3 trillion yuan is 3.5 times what they put in the previous 2 years. They put it in 2 months. So they're going for it. So there's been this injection of liquidity. And if you like, Frankenstein's monster have just had 1 billion volts surge through it, and it's starting to walk again. And that is why commodity prices are moving up. That is why cyclical equities are on a roll. Look at the German DAX index, a very cyclical stock market. It's moving exactly with this revival in commodities and in the Chinese economy. So number one is the Chinese are easing. Now, how long will this go on for? I don't know. Nobody really has great insight into the decision-making of China, but one would infer that it's likely to be maintained through this year because at all costs, the Chinese need to get their economy moving again. The second point is what's happening in the big economies. And let's take the US as a prime example here. The defining event, I would argue, is the British gilt debacle in September of last year, which some of your listeners may well recall, but that was a time when the new incoming prime minister decided to tear up the previous economic agenda and start to go for tax cuts and a pro-growth budget. Now, whatever the merits or demerits of that particular policy, the fact is that it seriously upset the sovereign debt market in the UK, and gilts, British gilts, the sovereign bond in the UK, sold off significantly. Now, the Bank of England reacted and managed to smooth that sell-off. But the key point to raise here is, had that same sell-off occurred in the US Treasury market, given the fact the US Treasury market is the most important asset market in the world, we'd now all be toast, okay? That would have been a devastating effect. So I believe that was a wake-up call for the US authorities, and since that time, they have changed policy. They are using balance sheet now, Fed balance sheet, to maintain financial stability and maintain stability and the integrity of the US Treasury market. And they're using interest rates to try and control inflation expectations and nail the inflation bogey. Now, if you come on to that financial stability dimension, the Fed's balance sheet has unquestionably been shrinking through this time. They've rolled off treasuries. They're doing a QT. I have no question about that. But the key point is that that roll-off of treasuries is not entirely a liquidity phenomenon. In other words, the Fed balance sheet itself is the wrong measure of liquidity, because there are various nuances, which means that every item in the balance sheet doesn't always create liquidity, and it doesn't always subtract from liquidity. And basically, if you drill down, without becoming too wonkish here, into the various items on the balance sheet, what you can say is that actually liquidity conditions from the Federal Reserve have flatlined at worst, and arguably have picked up since the low point in September. Now, two other pieces of data, or one particular piece of information, let me say. If you look at Bloomberg carries an index of Treasury market depth. In other words, it tells you how much you can trade in US Treasuries and sort of bid-ask spread. So in other words, if you're a big institutional investor, have you got the capacity to trade heavily in US Treasuries? That index, and we run a very similar one internally ourselves, bottomed in late September, coincident with the British gilt crisis, and it subsequently moved up significantly higher. On our index, not quoting the Bloomberg one, on our index, ranged between 0 and 100. It got down to 10 in September. It's currently just over 50. So there's been a huge increase in market liquidity, I would argue courtesy of the Fed. The Fed clearly has a remit to nail inflation, to provide employment, but above all, the Federal Reserve's job is to maintain the integrity of the sovereign bond market in the US Treasury market. And that's what I think they're doing. And it echoes statements that Janet Yellen made at the time. So in other words, bottom line, QT is dead effectively in the US.
Interesting. Okay, so QT is effectively dead here in the US. And
in my view.
Okay, in your view. And you point out that they've increased liquidity in the market because of their, I guess, their actions. Can we explore like some of the implications, what this might mean in your view, what this could mean for markets? What are some of the bigger implications here?
I think if you look at the implications, there are let's look at the three big markets: forex, equities, fixed income. If you look at let's take first of all the forex market. I think this is mildly negative for the US dollar. The dollar is anyway adjusting from a surge last year. One of the things that I argue, in fact, in my book Capital Wars, is that the dollar has been weaponized generally, but that's much more of a medium-term phenomenon. And within that weaponization, there'll be periods, short-term periods of strength and weakness. And currently we're in a period of somewhat mild weakness. So I believe that the dollar was likely to adjust downwards by about 20% from the peak seen in the end of the third quarter of last year. We're about halfway through that adjustment, okay? So in terms of currency, you're going to lose a little bit more if you hold US dollars. Better to diversify into other currencies. Second thing, what about the fixed income markets? My view is that the fixed income markets, and let's take the 10-year Treasury note as a benchmark, is likely to end this year pretty much around current levels, okay? And that is because you've got a two-way pull acting on the fixed income markets. Number one, interest rate expectations will come down somewhat. I don't think dramatically, but I think they'll come off from current peaks because the economy will soften to some extent. Not dramatically, but it will soften. On the other side, you've got a wonkish concept that is probably only known to bond investors called a term premium, which is the risk premia for holding interest rate risk. That is at its lowest ever reading on our calculations. It's very negative, and it can almost only rise from here. And those are the two components of a bond, interest rate expectations and term premium. One is coming down, one is going up. It'll be a wash. So the bond market will largely, we think, be range trading through this year. Okay, that is a backdrop for US equities. Slightly weaker dollar, sideways movement in bonds. I think what that means is that the S&P will range trade through this year. Okay, but the reason that there's opportunity is that unlike 2022, there'll be some big outperformers. Okay, last year nothing went up. We all lost money pretty much everywhere. But this year there'll be some big gainers. And in my view, those gainers will be in cyclicals, in emerging markets, in precious metals, and anything related to those areas.
Mm-hmm. So is that like when you want to pick your spot then?
Correct.
Gotcha.
And you can probably make money, in crypto. As I say, non-investment recommendation for crypto. But hey, look, it's the liquidity phenomenon. If liquidity is going up, it'll go up.
I think that's an interesting way of putting. I haven't heard anyone put it that way. Like crypto is a liquidity phenomenon. That's fascinating to me, like to hear it that way.
Well, it's a little bit like gold or precious metals. They tend to go up when there's monetary inflation. The current generation or the younger generation of investors are probably a lot less interested in gold and a lot more interested in substitutes like crypto.
Yeah.
That's where the marginal dollar is going.
Makes sense. There's such a wealth of information that you laid out in the last couple of questions. So I thank you so much for being on here and like, helping us understand what's happening in the world, because it is such valuable information. I wrote down a bunch of notes and just want to ask you some questions. I'd love to kind of hear more of your thoughts on the economy and the outlook there. And I know in the book you pointed out that that the 10 and the 2 yield curve can be a bit of a flaky predictor. So I also want to get that. I want to hear from you about that, because we often hear about, an inverted yield curve that some folks say like a recession will be inevitable within a certain time period after that happens. So let's start with more of your economic outlook, and then I want to hear more about that, the yield curve as well.
Okay, well, our thought process begins with the flow of liquidity. It then moves into understanding the fixed income markets. And if you get those, if you like, behaving consistently, then you can start to draw out a view about equities and ultimately about what the real economy is doing. We never use the economy to predict the stock market. We always think of the stock market as a predictor of the economy. Okay. Financial markets are forward discounting mechanisms. They look forward, not backwards. And I'm always reminded of the quip or the comment by the legendary investor Stan Druckenmiller, who always said the best economist is the internals of the stock market. Okay. And what he means by that is that if you look at the relative performance, say, of cyclical stocks versus defensive names, if cyclicals outperform defensive, it's telling you the economy is reviving, the cycle's turning up, and similarly vice versa. And that is exactly what's happening now. So it looks as if we're somewhat close to an inflection point on the economy in the US based on what the stock market is saying. Now, clearly that may be a fake breakout, for sure. I take that. But then what about the fixed income markets? What are the fixed income markets saying? Well, if this is a normal cycle, what you would expect to see in fixed income is, broadly speaking, 3 features right now. And I would suggest you're seeing exactly those. Number one, you would expect to see volatility in the fixed income markets starting to move down significantly. Now, in fixed income speak, there is an equivalent to the VIX index, which you'll be familiar with in equities, which is called the MOVE index, which is a measure of volatility. the move index is going down. Okay, you're looking at lower volatility because investors are factoring in less interest rate movement now, or if there's interest rate movement, it's downside movement. The second thing that you're seeing is a peaking in credit risk. Okay, so in other words, look at the spreads on US investment grade, look at high yield, or maybe even junk. And what you'll see is the composite of those rates have already peaked in terms of spreads, and they're coming down. And that's again what you should see at this stage of the cycle. The third thing is you should begin to see an upward inflection in the yield curve. Now, are you getting that? The answer is that you are and you aren't. If you start to look at longer dated tenors, like, for example, the 5-10 spread, or even beyond that, maybe looking out to 20 years or whatever, what you'll begin to see is that those spreads, in other words, that yield spread is beginning to widen out again. In other words, longer dated tenors in the bond market are trading at higher yields than nearer term tenors. It's not so obvious on the 10-2 or on shorter dated tenors. And the reason for that is that I would regard that spectrum of yields as being very highly distorted or heavily distorted by term premia in the bond markets being very, very negative. Now, again, this is a wonkish area, but let me just say that the term premia on a bond plays a bigger and bigger role in the pricing of a bond the further out you go in terms of maturity. So in other words, a 10-year bond will have a bigger term premia component than a 1-year bond. Now, why is that important? Because term premia are heavily biased downwards. They're big negative readings because of the shortage of collateral in the global financial system. Now, why is there a shortage of collateral? It's basically because there hasn't been a huge amount of issuance in the last decade, let's say. There's been a big appetite for collateral because of regulation changes, things like Basel III, Solvency II, which have affected the banks and the insurance companies. Many other countries have not issued as well as the US, but it's really the US Treasury market and the German Bund market that you would really classify as being pristine collateral. It's what the this is what the dealer banks or the banks want to hold if they're if they're lending against collateral. And the whole point is that the financial system globally, but particularly in the US, is now collateral based. It's not about you or I going into a bank and getting a bank loan. We're talking about wholesale money here. We're not talking about retail loans. We're talking about the wholesale money, many, many times bigger. And it's that money which is driving financial markets. And it's what's driving the bond market. Now, why have I gone down this sort of side road of talking about term premia? For the simple reason that's what's biasing the yield curve, the 10-2 spread. And the 10-2 spread, as I mentioned in the book, has got a flaky track record anyway of hitting the recession points. It's not bad, but it certainly isn't fail-safe. And if it's being heavily distorted by term premia, it's going to be a fairly useless indicator. So what you're seeing in the fixed income markets now, parche what the yield curve is saying, is other measures are absolutely on track. They're telling you that the liquidity cycle is inflecting and it's moving up, and therefore you'd expect to see the economy bouncing. Now, if you take what the fixed income markets are telling us about the economy, what you would expect to see is a turning point in the US economy around May of this year. Okay, so we're going to get a few more months of softness, there's no question about that, but we're near a turning point. And I think that's what a lot of the economic data is beginning to say. Now, if take that statement as being a May date, I picked off, in fact, on my Twitter feed, which is at CrossBorder Cap. If you look at that Twitter feed, there was a tweet I put up, which I took from Capital Group, and Capital Group had done an analysis which said that the stock market always picks up 6 months before a recession. Okay, well, if May is what the fixed income markets are telling us, looks like the stock market's on track again, doesn't it? It's picking up about 6 months ahead of where the economy's inflection is going to be. So everything seems to be lining up. Now, of course, we can be wrong, but what I'm trying to say here is that we've got 3 pieces of information which seem to be going right. Liquidity has turned, the bond market is telling us that's a decent turn, and the stock market is discounting it too.
Wait, okay. So just to clarify, I just pulled up your tweet. So and it says the bond market points to a May 2023 low in the U.S. economy. If stock markets move 6 months ahead of the economic low, then this rally could be the real thing. So far, liquidity agrees, and you have to Capital Group. So, am I kind of hearing that? Okay, so that will be the low, and it's up from here. That it's not going to be like some deep recession that some folks have been calling for. I mean, some folks are expecting that. I guess they're more bearish than others. What is it signaling, just to clarify?
Well, I think there are two things to say as regards this, Julie. I mean, one is that a lot of people are resting their view of deep recession on the yield curve and how negative the slope of the yield curve is. What I've tried to say is that there are good reasons why that's distorted. And it's not telling us about economic dislocation. It's telling us more about potential financial fragility because of the lack of collateral. But one of the other things I said earlier on is the Federal Reserve is onto this. And the Federal Reserve is basically now putting liquidity in because it wants to maintain the integrity of the sovereign debt market, the Treasury market. This is their paramount job, okay? Lose the Treasury market and you lose financial markets and you lose the economy. Look at the devastation that occurred in the GFC when effectively the Federal Reserve lost control temporarily. Okay, there was a free fall. Okay, deep recession. They want to make that mistake again. So I think that number one, you're seeing evidence that the Fed is in control, and there are reasons why the yield curve is biased and giving a false signal. The other thing to say is to raise a hypothetical question: is that what you've got going on in Europe is another war. Okay. And there has been, as many people will have noticed in the media, reports of a lot of assault weapons, tanks being sent out from many countries to Ukraine. Now, a tank is not a defensive weapon, it's an offensive weapon, in my book anyway. And so that would suggest that the war is going to escalate even more. If you're a politician in the West, would you want to create a recession this year? I don't think so. It would be pretty inconvenient if you're going to up the ante and attacking Putin. So I don't think that anyone wants to create a big recession this year. Okay. Now I take all the points about, Jay Powell wants to mimic Paul Volcker. He's a tough guy. He's going to nail inflation, all that sort of thing. I buy all that. But at the end of the day, there's been traction on getting inflation down. I think that if they're going to act like Volcker, and probably they will at some stage because the debt mountain is unbearable in many ways, it's too much debt around. Better to do that in 4 or 5 years' time, allow a little bit of inflation to come through in the system. That will devalue your debt a bit and make it more workable, and then hit it 4 or 5 years down the road when the economies are stronger and the geopolitics look more straightforward.
That is fascinating. Again, it's awesome to have you on, just because there's a lot that might not be understood, like the way you were pointing out term premia and kind of why that's messing with the yield curve, and then pointing out here that the Fed or risk premia rather, and the Fed is being in control here, and how with our debt, it sounds like with our debt situation, you need a little bit of inflation to solve for that. Is that correct?
Yeah, I think it makes it easier if you can devalue debt in real terms. I mean, the US, clearly has a debt problem. I mean, the fiscal arithmetic doesn't add up. But once you start to take a global perspective, then you see that, actually the US is the cleanest shirt in the laundry here. A lot of other countries are in far, far, far worse shape than America is. And that should mean that the dollar at least, keeps its head up through most of this turmoil.
Yeah, I like that. The cleanest shirt in the dirty laundry pile. I took some notes again from your book, and maybe I want to ask as another follow-on because, and I don't know why I wrote this line down, but in the book, I guess you were kind of talking about how financial markets, they spin on fragile axes, and the absence of liquidity often provides a warning of upcoming troubles. But here we've seen an inflection in liquidity, so I think it probably bodes well. I also wrote down that central bankers should focus on financial stability versus phantom CPI targets. So is that what we're seeing the Fed do here right now? As you mentioned, they're in control. They're focusing on the financial stability. What, help me understand?
Yeah, I think absolutely. I mean, this, as I said, is the ultimate job of the central banks. That's why, ultimately, why were central banks invented? That was the reason. Inflation, they've only inherited this inflation mantle recently. Originally, central banks were there to basically help the government with its sovereign bond issuance. So they're coming back to their origins in that regard. But just evidence what happened in Britain at the time of the gilt debacle in September. The Bank of England was operating a QT. Within seconds, they reverted to a QE. They threw the inflation remit out of the window very quickly.
Yeah. And that was probably like, as you mentioned, that was a major wake-up call for here in the US.
I think it's a wake-up call for everybody worldwide. I mean, we look at as I indicated, we monitor 80 or 90 central banks worldwide. If you look at a heat map of all those central banks and how they're moving, what you see is the beginnings of an inflection around about October of last year. Everyone is starting to become a little bit less tight at the margin.
I want to hear your thoughts on your more of your outlook on the US dollar and the role of the US dollar globally.
Okay, well, let me sort of use that as a sort of segue into what the Capital Wars book was about, because there were three basic themes in Capital Wars which are all about this question of the role of the dollar. And the first section is really saying, look, let's begin with Bretton Woods. Okay, people have heard of Bretton Woods. That was the international settlement that took place in the US in 1944. It was before the end of the war, but it was effectively trying to outline what the world economic system would be. And that is commonly sort of referred to as Bretton Woods 1. And some people have the idea that there's a Bretton Woods 2 and maybe even a Bretton Woods 3 coming up. No way is that true. We're still in Bretton Woods 1, okay? Bretton Woods 1 was basically about two or three things. It was about putting the dollar at the center of the world economic system. It was about essentially using the IMF and the World Bank to police payments problems in the world economy. It was about the US acting as banker to the world. Now, let's unpack that a little bit. What does that mean? What it means is that if the world economy needs credit, dollar credit, the US provides that. And if the world economy wants dollar savings instruments, the US provides that, okay? So the US has got the flexibility to move both ways. And that is the efficiency of the US financial system, US financial markets. Now, many people would argue that the US running a large trade deficit is indicative of American industry being uncompetitive. Completely rubbish. It's much more about the super competitiveness of US finance, because balance of payments have to balance. So if the financial sector has got a big surplus, it means that the industrial economy must by definition be in deficit. So this is much more about the strength of US finance. So the other plank is this idea that the US operates as a banker to the world. And the final point is all this was backstopped by the US military. Now, tell me which of those 4 points has changed since 1944? None of them, okay? True, we have moved from fixed exchange rates to floating exchange rates, but that wasn't a major plank of Bretton Woods necessarily, okay? It was obviously there in the agreement. But actually, paradoxically, the move to floating exchange rates actually underscored the role of the US dollar even more, because it basically reflected the growing power of US banks. And what you saw was an explosion in dollar liquidity really since the early 70s onwards. And it's all about the dollar system. Now, that was part one, which said that where we are is in a situation where the US dollar is dominant and the US financial system remains banker to the world, okay? The second part of the book was then saying, how does liquidity evolve out of this? And what we were arguing, this is much more sort of academic or wonkish stuff, but it's basically saying that what you've got to understand is that the world has moved on from high street banks. You don't look at money supply anymore. All these sort of well-rehearsed arguments is what you've got to start looking at is wholesale money, take a global view, and understand that the repo markets, for example, or the FX swap markets are really where you're getting a lot of liquidity generation now, and in particular in the US, the role of JP Morgan, as it happens, in the tri-party repo system is a huge liquidity generator, potentially, okay? And that system needs to be understood as to how liquidity evolves and is created in the system. And that's why we're seeing one of the themes in the book unfold, which is as the world gets bigger financially, it becomes more and more volatile. And that's because of this liquidity cycle unfolding. The third part of the book is basically about China and about the coming clash between America and China. China has put on record explicitly in black and white that they want to unseat the dollar as the major currency, not just in Asia, but probably in the world. Asia is the first step, and they want to do that. China has got this as its goal, okay? Now, how will they do that? The answer is it's going to be difficult and it's going to take a long time, but they're trying. In the book, I said that they would largely look at this in terms of three ways. They would first of all change the currency denomination of trade, okay? In other words, they'd stop invoicing in American dollars and they'd start invoicing in Chinese renminbi. Now, given the fact that China is the world's biggest importer and exporter, they can do that at the stroke of a pen, essentially overnight. Why is China currently setting up swap lines? So in other words, central bank to central bank swap lines for yuan around the region, the Asian region and Central Asian region. Reason being is they are about, at some stage, it's imminent, they're going to change to a yuan-based or renminbi trade invoicing, because that's the only reason they will have these swap lines in place. So you know it's coming, right? Number two, they want to open up their bond market to foreign money, because basically China needs to have something that foreigners can invest in, okay? And it needs an active bond market, because the bond market, think of the Treasury market in America, is the benchmark against which all other assets are priced. So you've got to have an efficient bond market. China desperately needs to financialize its economy. Its industrial economy has mushroomed to become, the elephant in the room. But the financial economy is the mouse next to it, if you like, to draw that and extend that analogy. It needs to develop pretty fast. And the third thing is to basically get a vehicle that people can trust, and that may be some sort of digital currency, which will allow peer-to-peer transfers between yuan and other currencies. So they basically need to do those things. But ultimately, China has to financialize its economy. Now, the question to ask is, how successful will China be at beating the dollar, surpassing the dollar? In my view, not very much. It will, it's chipping away, there's no question. But what China basically has to do is act as banker to the world. And there is no way that China is in a position to do that now, because China runs an embedded trade surplus, largely because of the inequality of income distribution in the Chinese economy. That will be a huge structural change for them to alter that. It would effectively mean I can't see how they can do it without impairing or dismantling the communist system. So that's not going to happen overnight, unless of course it does. But basically, China is chipping away at the dollar's dominance. Dollar hegemony is here for some time, I would say, and China is not really going to get a serious look in. Now, if you come back to the conclusion in all this, what it's basically saying is that if you want to understand equity markets in general, what you've got to start to think about is the PE multiple of the market is driven by the Federal Reserve and the dollar system and dollar liquidity, and the E is made in China, because China's economic footprint is so big. So when the PBOC in China starts to inject more liquidity, what you find is it jumpstarts the Chinese and regional economies, commodity prices start to surge, and earnings start to look a lot better globally. And that's why you're looking at the German stock market racing away at the moment.
Yeah. Can you help me understand the very last part of it? When you're talking about understanding equity markets and the PE multiple driven by liquidity, can you just re-emphasize that? I was taking notes. I want to hear a little bit more on that.
Yeah, well, I mean, the question is how does how does liquidity ultimately affect stock markets? And you might say, well, okay, you've got two moving parts in the stock market. You've got the earnings, which everyone's familiar with, and I'm arguing that China has such a big impact on the earnings because it's the dominant economy worldwide, certainly at the margin, a big cyclical economy. And on the other side, you've got the rating of the market, the rating of stocks, which is the PE multiple. Now, the PE multiple is very sensitive to liquidity. And to take a sort of hyper example, let's look at technology stocks. Well, as I said, technology stocks are like a long duration investment, like an, if you like, an undated bond or perpetual bond. And so they're extremely sensitive to slight movements in rates, bond yields, or liquidity. And that's exactly, that's, if you like, the extreme, but the stock market overall is moving in the same way. So if you expand liquidity or you drop interest rates, you will find the PE multiple goes up. And equally, if you tighten liquidity, the PE multiple comes down.
Got it. Another thing that you brought up in one of your answers was when you were just talking about like kind of understanding like how liquidity works. You were mentioning like repo markets, for example, and like all these huge liquidity generators out there, and understanding how it evolves. And this was interesting to me. As the world gets bigger, it becomes more volatile. Are we going to become increasingly volatile, or is this just kind of going to be like the new paradigm that we are dealing with? Like we'll have more crises ultimately, or is there a way to make the world less volatile? Would love to explore that theme with you.
Well, I think that can you go backwards in history? And I think the answer is probably not. So we're in an evolving financial system, and there would have to be extreme regulation for us to avoid the path we're going down. And effectively, what's happened is that the world has moved from a situation where credit was largely given on trust to a situation where credit is now dependent on collateral. Now, if you're a mortgagee, in other words, a homeowner with a mortgage, you're familiar with collateral because basically collateral is the value of your house against which the bank is lending, right? So that's a collateral-based loan. But prior to the global financial crisis, we used to see quite a lot of non-collateralized lending, but non-collateralized lending is fast disappearing. Most lending now is collateralized lending. So it's either against a real estate, or it's against a security like a Treasury bond or a German Bund, or maybe even in extremis an equity. It's possible to do that. Okay, if you're margining on the stock market, you can basically use equity. Okay, but the thing is, the haircuts move, the margin requirements alter, etc. And the reason that that becomes an important issue is that what this does is it makes the entire financial system very, very pro-cyclical. So in other words, if you get a sell-off in the market, then what happens is that margining requirements start to step up. In other words, haircuts on the collateral will rise, etc. And that means that you may be forced to sell in a falling market. And so it drives the market down again. Now, some of your listeners may be familiar with the so-called LDI crisis in the UK that coincided with the gilt debacle. In fact, it was probably a precipitating factor. And the LDI refers to liability-driven investments. And basically what these vehicles were there were products that were bought by pension funds to try and better match their liabilities, but they were very leveraged. So what happened is that when the gilt market sold off, these pension funds were forced to find more margin, and they had to basically sell even more gilts to meet their margin requirements. It pushed the market down. So what you've got are these sort of spirals going on, and that's an important thing. Now, what adds to all this problem is that we're living in a world where there is this huge, huge debt, right? I mean, this is the problem. Why did we get into this mess? Because central bankers, and, we can name names here, but, people like Alan Greenspan, Ben Bernanke, decided they wanted to have near zero interest rates. And in Britain, the Chancellor, George Osborne, had this crazy idea of following an austerity policy. And what that does, the austerity policy is pushing, government austerity, is pushing more and more debt onto the private sector. Low interest rates that Bernanke and Greenspan oversaw effectively encourages, incentivizes people to take on more debt. So what's happened is the debt mountain has just grown and grown and grown. Now, why is that a problem? That's a problem because with debt, you either repay it, not much chance of that, I don't think, or you have to roll it over. So if you've got a 5-year debt on average, which is actually where the world economy is at the moment, and you're sitting on a debt pile of about $250 trillion or so, okay, what you've got to do is you've got to roll that. So you're talking about rolling something like $65 to $70 trillion of debt every year, okay? I mean, this is a huge amount. How can you roll debt? You need balance sheet capacity to do that. And what that is liquidity. So what you need is lots of liquidity. So what you've got into is a vicious circle here, which is basically saying the more debt we have, the more liquidity we need. If we don't get that liquidity, you get a financial crisis, because all these financial crises we've been looking at in the last 2 decades have been refinancing crises. And if the liquidity comes to offset the roll, or to supplement the roll in the debt, that liquidity will spill out somewhere, and it spills out into asset markets. And if there's lots of liquidity, it spills over into the real economy. So you get surging asset prices and then inflation in the high street. And that's pretty much what we've seen. Now, what we're emphasizing here is the quantity of liquidity, bear in mind. I'm not mentioning interest rates. Interest rates are a secondary consideration. If you've got a home and with a mortgage, and you need to roll that mortgage, in other words, it comes up for renewal, you need to roll that mortgage, you need to find somebody who you can roll it with. In other words, another bank that will lend to you. You're not so worried about what the interest rate is. You just determined you're going to get the roll, because if you don't get the roll, you're homeless. And so this is the same with debt. If you don't roll the debt over, you'll default. And if you get a default, you get a cascade of default through the system. You get systemic risk. And that's the situation we've got into. So you can see what I'm saying here. Why, as the world gets bigger financially, it becomes more and more cyclical. So these financial crises are going to start to, appear more regularly in the future. And as a result of that, central banks and the Treasury have got to get to grips with or control the bond market. Now, this leads on to another, side avenue, if you like, which is to say, look,
I love it. Let's do it.
Right. Japan is the canary in the coal mine, because everything that you've seen in Japan has been translated back into the US or Europe a few years later, whether that is demographics, aging demographics, whether it's disinflation, deflation, QE, zero interest rates, yield curve control. It's coming to a high street near you soon. And the fact is that Japan has been playing around with yield curve control for about 5 years now. I would argue that yield curve control is actually in nascent form already existing in Europe and in the US. And maybe this is what the Federal Reserve is doing at the moment in terms of the Fed's balance sheet, is trying to control the Treasury market. And, there was a very clear statement that was actually delivered in a conference by Brookings in September of last year, where a number of notable US academics were asked the question, what is the level, the minimum level of US banks' reserves that banks need to hold and the Federal Reserve needs to supply? Now, the answer they gave was about $2.5 trillion US. Okay. Our figure is a tad higher than that, maybe about 2.6, 2.7. But hey, I mean, this is a ballpark pretty much the same. Currently, US bank reserves are 3 trillion. But what you've got is the Treasury General Account, which is an item on the Fed balance sheet, which is swinging around because of the upcoming debt ceiling. And that will go up during the tax season and then be drawn down significantly, etc. That extra volatility in the Treasury General Account is probably giving us a warning that bank reserves may be more volatile than we've seen for some time, potentially. And therefore, the Federal Reserve needs to have a margin of error in that calculation And therefore, holding bank reserves at about 3 trillion is very important. And that's what I would suggest they're doing. So I think they're basically operating now in a way which is, if you like, a quasi yield curve control that's going on in the US. They're obviously not targeting, well, let's say obviously not, they're probably not targeting rates or yields in the way that they did before, but there's clear manipulation. And if you roll out a few years, what you've got is a situation where the US fiscal arithmetic, as we know, doesn't really add up. There's going to be a lot of issuance coming through because of aging demographics and the fact that, basically mandatory spending starts to skyrocket. And with aging demographics, the working age population, which is the tax base, is shrinking the whole time. And so what you've got is very unattractive fiscal arithmetic with a lot of issuance coming. That is a threat to the financial system because basically it means that there's upward pressure on yields. Though I keep saying, and I'll say again, that the US is the cleanest shirt in the laundry here. Others are in much, much worse shape.
Yeah, like others are in worse shape. Just can we go a little bit further about this? The fiscal arithmetic here in the US not adding up. I want to hear just a tad bit more on that. And do you think, I'm just asking here, do we need even more reserves? What do you think? Or like, what, I want to hear a bit more on this.
Well, I think there are two separate things. I mean, one is what is the level of reserves or liquidity in the US money markets, which is the point about what the bank reserves and what Fed liquidity is trying to engineer. And I think the fact is that we're in a world where you need liquidity because of all this debt. Now, in Britain, in the 19th century, sort of way back then, there was the financial markets were not dissimilar in many ways to the structure of financial markets in the world today. Kind of paradox, but it's true. And that is because repos and bills were very prominent then, because London was a big trading center. The bill on London was a major financial instrument, and that's how the situation grew up. And in, I think it was around 1866, there was a major default with a bank called Over Gurney, which failed, and the Bank of England refused to lend money to Over Gurney, and it collapsed, and it was a big financial disaster. Now, Over Gurney was the biggest financial institution in the world then. It was equivalent to a giant shadow bank, and it was let to fail, and there was a financial catastrophe, okay? Out of the embers of that financial catastrophe, Walter Bagehot, who was a British journalist, who the US author Jim Grant has written a fantastic biography of Walter Bagehot. Walter Bagehot came up with a rule for central bankers, and that rule was to lend freely against good collateral at a high rate of interest. In other words, create lots of liquidity, have good collateral, but charge a high rate of interest for it. What have our central bankers been doing for the last decade? Exactly the reverse, right? But maybe they're now getting the message that they need to create more liquidity and have more liquidity in the system. So that's that side of it. On the fiscal arithmetic, I said the US is the cleanest shirt in the laundry. But let's look at some comparisons and look at the risks that the US is nearing here. And let's be clear about this. In Britain's case, you can work out the idea of basically how much tax revenue covers tax revenue minus mandatory spending, how much that gap covers the interest bill, okay? So you've got all your tax revenue, income taxes, excise taxes, whatever. You subtract from that the mandatory spending that is there for Social Security, what education the public sector does, etc., Medicare, blah, blah, right? And you're left with a residual. How much does that cover the current interest bill on the debt? Let's go back to Britain. Before the celebrated Liz Truss budget, that covered it 1.8 times, okay? So big, healthy margin. By the time of the budget, after the budget, prospectively, that went down to 1.2, and the British gilt market collapsed, right? What is that figure today in America? The answer is 0.8, right? And on the CBO's figures, Congressional Budget Office figures, goes down to 0.3 in about 5 years' time. So that's the problem.
Yeah.
Debt's got to be issued, and therefore yield curve control is coming. in some form. Or the Federal Reserve is going to have to be active again in the debt markets by actually buying treasuries. And I suspect they will.
Yeah. Just like another quick follow on though, like, yeah, you're just mentioning like our debt situation here and like, we're operating at a deficit year after year, with yield curve control coming from the Fed. What is that? Can you help me understand like what that looks like, or what some of the, could be some of like the implications of that?
Well, it could be. I mean, it can take many shapes and forms, and it's a sort of generic catch-all to talk about yield curve control. It could be targeting a certain rate. It could be trying to do things to keep the 10-year bond below a certain threshold. It could be that. It could be, explicitly saying to financial institutions that they have to hold minimum levels of treasuries. I mean, that's more or less there already, but that clearly be ratcheted up. It could be in extremis saying that there are exchange controls. I mean, that won't happen. Foreign exchange controls on foreign investment, that won't happen. But it could be saying things like, US institutions are forbidden to invest in China. I mean, this is a sort of backdoor way of keeping money at home, obviously, or various other guises. It's this saying that the authorities have to get more control over the sovereign debt markets, because the sovereign debt markets are the big thing. That's what moves or controls the financial system. The US Treasury market is absolutely paramount. Needs to be, carefully controlled or manipulated or stroked, or whatever you like to say.
Yeah.
Take care of it. It's important.
Well, Michael, I have learned a ton. I don't know how many pages of notes I have, but I have a lot of notes here. Just I feel like I learned a lot from you, so I thank you so much for that. But I want to just give you a few minutes for some parting thoughts. Obviously, let folks know where they can find you, pick up your book and whatnot. But also, like, if you have any parting thoughts for the audience at home listening and watching, things that they should certainly be thinking about.
Yeah, I think that in terms of how to get in touch with us, we've got a website which is crossbordercapital.com. We've got a Twitter handle which is at crossbordercap. There's also a LinkedIn. I've got a LinkedIn site as well, so all that's available. If you want to read the book, it's called Capital Wars. It was published by Palgrave Macmillan in 2020. It's a sort of semi-academic tone, so I wouldn't necessarily say this is going to be light reading. I mean, it may be good bedtime reading because it might send you to sleep at times, but it's basically talking about, as I said, the whole idea about the evolution of the global financial system, how liquidity is created, and the upcoming threat of China. All those aspects are sort of in the book. And I tend to think in terms of sort of a parting thought about what to do now. I would say that think of it in these terms: liquidity drives financial markets drive the economy. I don't think that forecasting the economy is an easy job, and I don't think it really helps us very much in understanding financial markets. It's all about liquidity and the flow of money, and that's pretty much what we do. And if you want a sort of a quick and dirty heads up as to the sort of things to look at, if you want to watch barometers of liquidity, there's no one unique one. I mean, we obviously do detailed monitoring of liquidity, but look at some of the liquidity barometers. Look at crypto, look at gold, look at technology stocks, look at the slope of the yield curve. All those factors are probably, at the end of the day, pretty good barometers to say that liquidity is moving up. And if liquidity is moving up, it's a risk-on environment. And then you want more higher beta investments. You want to take more duration, etc., as they say in bond speak. And take on more risk. And then when the liquidity cycle starts to turn down, you want to do the opposite. The liquidity cycle lasts, as our research says, probably about sort of around 6 years.
Yeah. Well, I read the book and I should read it again too. And it's a fascinating read. I certainly learned a lot, and a lot of it's still over my head. Obviously, you could tell that, but I really appreciate you so much, Michael, for coming on. Certainly learned a lot from you. We'll definitely start paying more attention to liquidity. And I highly recommend the book, and for folks to follow you as well. Michael Howell, CEO of CrossBorder Capital and author of Capital Wars. Thank you so much for being so generous with your time and your ideas. I really, really appreciate it.
Great, Julia. Great pleasure to be on. Thanks so much for the invitation.
Thanks, Michael.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.